All righty. Welcome, everybody. I am Jeff Rhodes with Crossroads Consulting. My partner, Billy Rhodes, is not with us today, but I've got a exciting interview coming up with Jeff Mitchell, Managing Director and Chief Operating Officer at Aegis Business Credit. But first, a quick reminder, Crossroads Consulting is designed to help businesses outsource, grow, and protect their assets. Everything you want to know about us is on our LinkedIn page, our website. Click the link below. And by the way, if you have any questions, submit them in the comments section, and we'll be happy to get the answers from Jeff. And with that being said, Jeff Mitchell, welcome to our XR Consulting Insights program, where we do interviews with key people such as yourselves that impact businesses greatly. Welcome, and I look forward to learning more about Aegis Business Credit and the things that you guys do.
Sounds good. Thank you for having me.
Absolutely. So, let's start off with your background. I know it's pretty extensive. I know you've done a lot of work in the alternative finance space, but go ahead and give us your full background, if you don't mind.
Sure. So, yeah, I've actually been in the industry. It's hard to believe, but it's approaching 40 years now. And I've been both on the bank and non-bank side of the specialty lending space, specifically asset-based lending. I got my career started at First Union National Bank. Well, I take that back. Actually got my start. My family had a commercial finance company in Atlanta that still exists today that did receivable financing and factoring for small businesses. My father had been an IBMer. His partner was a Citicorp banker. They both lived in Atlanta, but they were about to be transferred to New York City, and they decided to put their heads together to come up with a business that would leverage both the banking finance side and the computer side. And they launched a company called Advanced Financial back in the mid-'70s. And so I kind of grew up literally around the dinner table hearing about, the plight of the entrepreneur and small businesses and their various types of financing needs. So flash forward, when I graduated Florida State University with an economics degree, I had been, my first position was with Coca-Cola, and my father's company was actually expanding in the early 80s, and he approached me and said, "Hey, we're looking to expand and add a couple of business development people. Financing small businesses is a lot of fun, and if you like it, you'll have a career, and if you don't, you could always go back to pushing soft drinks and things like that." And so long story short, I actually got involved with the industry through that finance company, where we were providing small receivable financing facilities for small businesses around the Atlanta area. That business grew. We ended up ultimately selling in the early 90s. And at that point, I joined First Union National Bank in their commercial finance or asset-based lending group, and was essentially the product specialist for the state of Florida, working with relationship managers around the state, the portfolio folks, and the credit folks. So to the extent they came across a company that needed working capital financing, I would come in to structure a borrowing base around their needs and come up with a line of credit that leveraged their receivables, inventory, and equipment. And, so that's really when I, kind of joined a larger institution. So I had seen how a small company operates, like Advanced Financial, and then evolved to the First Unions of the world to finance much larger businesses. The long and short of it is companies, regardless of where they are in their evolution, they do need some sort of working capital component to help, manage their day-to-day working capital needs like payroll and paying vendors. And depending on what their balance sheet and performance history looks like, will dictate where they can get that type of solution. And so, my background has really been dedicated to working with both banks and non-banks, and all specifically working with companies in need of working capital for one reason or another.
Yeah, Jeff, that's outstanding. I'm glad you shared your background with us. I learned a lot just listening to you talk. I've gotten to know you pretty well over the last several years. When we look at what Crossroads Consulting does and the intent of these interviews that we've been posting on our YouTube page, when you look at the evolution of a business from start, the very beginning of a business, taking off the whiteboard and actually implementing a business strategy, to all the way through to the exit of that business owner strategy, and all points in between, is kind of where Crossroads Consulting is focusing. And you're a perfect component to our ecosystem, because obviously nobody can have all of the expertise that a business owner is going to need throughout the life cycle of their business. So it's critical in running a business to have resources, top resources that you can go to for specific needs, and you fit that bill perfectly. I mean, it's incredible that you've had such a introduction to the finance world at an early age. It's in your blood, it's in your DNA. It's quite interesting to the extent your background goes. So with all of that being said, can you give us some insights into the financial markets today and the challenges businesses have with finding working capital, funding startups, et cetera? What's just the state of the lending environment at this point in time?
I mean, it's really difficult, or challenging, I should say. When a company opens up, when an entrepreneur opens up a company, they obviously need working capital. And in my experience, pretty much out of the gate, they're undercapitalized. They usually get out of the gate with family and friends type of money. And, they immediately start incurring revenue and expenses. And they quickly realize that in addition to what they use to start the company, they need working capital, some form of line of credit to kind of bridge the gap on their funding needs between the time that they actually need the money to make payroll, to pay vendors, and when they actually get paid, by their customers. So generally, a working capital line of credit is the funding source that bridges that gap. But when they're an early stage company, more often than not, they go through a period where they're just not profitable. It takes a while for every business to kind of get some sort of critical mass where their top line revenues are sufficient to fund the needs of that business, to where ultimately they have a positive bottom line. So inevitably, where most entrepreneurs go is they first go to their bank, and their bank will look at it and say, ideally the bank wants to have 1 to 2 years of historical, positive net income performance before they can provide any type of financing. And, when they can't meet that, or maybe their balance sheet is a little bit too leveraged, then the bank usually is in that envious position of saying, look, as your trusted advisor, you're not ready to be financed properly from a traditional bank, but there is an alternative source of financing market that you could go to, where us as the bank, we want your bank accounts, we want the bank relationship, but where your working capital need is, where your borrowing need is, it's just premature for you to be in our traditional bank environment. So what most of our relationships at Aegis Business Credit come from those types of banks, where the bank says, hey, we've known these people for a long time. They've got a nice business. They're tracking in the right direction. It's just a little bit too early for us to provide the financing because their balance sheet's a little bit too leveraged. Their earnings history is a little bit too erratic for us to underwrite it at the moment. So they would then refer to folks like Aegis Business Credit, where we would look at their balance sheet, we would look at their P&L, but ultimately where we focus our underwriting is on the physical assets, on the receivables and inventory. And then what we do is craft a line of credit where we come up with advance rates against those receivables and inventories to kind of back into what that working capital requirement could be if those receivables and inventory are leveraged.
Man, I got a lot of questions. My head's kind of swimming a little bit here. You said a lot. So there's obviously different stages of business life cycle that you focus on. The startups obviously are going to be hard for anybody to fund, and usually it does take friends and family money. But at some point in time, startups can generate some revenues. Now, they may not have profit, they may not have a lot of assets. Then you move into a more established company, but there's still challenges with an established company in getting funding. How does the economic state, interest rates, recession, no recession, growth, how do the economic factors play into the financing world?
I mean, I think when a traditional bank is looking at any relationship, they want to understand the industry that they're lending into, as well as the company itself on who they specifically sell to. Where industry is concerned, certain industries are more susceptible to downturns in the economy. For example, construction companies are very cyclical. There are periods where the economy is thriving. There's plenty of liquidity in the market. People are building, people are renovating, people are doing infrastructure improvements. But when we go into a downturn, or a recession, if you will, then a lot of those projects kind of, I don't want to say come to a screeching halt, but they certainly slow down. And ultimately, the ripple effect of that slowdown is going to impact that borrower and their ability to service any debt if they've borrowed from a bank.
All righty. So that's, and we see swings in the economy that happen rather quickly, almost on a unpredictable scale. Is there any particular industries that you favor in your line of work right now?
Yeah, so that's a good question. So as an asset-based lender, I mentioned that we finance accounts receivable and inventory. The industries that are aligned with best with what we do, we like to work with manufacturers, wholesalers, distributors. We do quite a bit of work with service companies like staffing firms. What we do shy away from are, cyclical types of industries, construction, for example, because when we finance an invoice, we want to kind of understand, let's say it's a manufacturer, they're manufacturing some sort of widget. Once that widget has been manufactured and shipped, then at that point, our borrower generates an invoice to their customer, and their customer gets maybe 30 or 45 days to go ahead and pay that. It's very predictable. Whereas in a construction environment, a lot of those types of jobs are on a progress billing basis. And our concern as an asset-based lender is, God forbid, if there's some sort of performance risk associated with their ability to complete a project, that may impair their ability to collect on that invoice that they billed for. So what we're really looking for are the types of invoices that represent goods or services performed or delivered, and really free of any claims, disputes, offsets. I mean, my customer ordered a widget, we manufactured it, we shipped it to them, and now that widget's going to be paid. So it's a much more predictable type of invoice, if you will, to finance.
Yeah, it's all about debt service, right?
It is.
Their ability to cover the debt service. Tell me about the process, because I hear from a lot of business owners that the process is painful. They never have the financials in order. They're always having to modify their financials. But give us some insight on how to prepare for funding efforts, whether it's traditional bank or whether it's through asset lending, as you guys do. But take us through some of the processes in preparing for seeking working capital.
Yeah, I think as a business owner, when you decide, okay, it's time to go to the bank, or anybody else, to look for a line of credit or some sort of term financing, it's important that you as a business owner really understand what your needs are, so that you're in a position to properly articulate that to the banker or to the finance company that you're looking to borrow from. So I think in terms of a package, if you will, have a very clear idea as to what the ask is, and why. You'll generally want to have the last 2 year-end financial statements, along with tax returns, as well as a year-to-date financial statement and a financial statement for the prior year, just to show comparison and trends. Generally, we would ask for a copy of your most recent accounts receivable aging, generally in a what I call a summary detail format, where it's all summarized by customer, but we see the individual detail behind the receivable agings, so that we see the individual invoices listed on the aging. We would ask for the same thing for accounts payable, so that we could see, are you, paying in terms, or how aged out are your vendors? For example, if you've got, $1 million outstanding to your vendors, we want it broken down in that current 30, 60, 90-day format, so that we can really understand, how you're keeping up with the terms that you're being given from your vendors. We also get an inventory summary, so that we understand, what does your inventory actually consist of? Is it in raw material form, or is it work in process, or is it finished goods? Because the lender's going to want to, in order to back into what they can lend, they're going to want to ideally understand, what does that inventory consist of? Is there more value in finished goods or more value in raw materials? Seldom do they lend on the work in process.
So this is interesting. So what Aegis Business Credit does is you help them put the package together, help them tell their story, and then you go out to the market and look for the money. Is that correct?
No.
Okay.
That's
When
no.
I asked that question.
I'm glad you asked. No, we are the direct lender. So when a company comes to us, and I'll give you an example. I had one this morning, on my way into work, called, and This is a staffing company that is growing rapidly over in the Orlando area. And they currently do not have a line of credit. They had a substantial amount of equity capital that enabled them to kind of get out of the gate. They've been in business about 5 years, but now they're beginning to land huge staffing contracts that have significant payroll requirements. And they need a working capital line of credit. So they called and said, hey, we've spoken to our bank because our balance sheet is still a little bit too leveraged for them to provide the line of credit. And because we're growing very rapidly, they've indicated that it's premature for us to get it from them. And so in speaking with us, I would request them to put a financial package together for us. And then we would then evaluate, how much of a line of credit we could actually provide them to help support their working capital needs.
That sounds like they're involved in government.
They actually they do both government and non-government stuff. So yeah, some of the contracts that they do have are with government agencies where they can only bill once a month under their contracts, but the challenge for them is they have weekly payrolls. So every single week they've got employees out there in the field. They're performing their work. They're billing on an hourly basis, but they have a payroll to make every single week. But they really can't bill till the end of the month, which kind of creates this inherent gap in their cash flows.
Interesting. What are some of the ratios that you look at, from a debt service perspective, revenues to debt, all of that? What are some of the key ratios that you guys like to look at?
So I think first and foremost, we're looking at the collateral base, and then we come up with percentages that we lend against the receivables and inventory. So a customary advance against an accounts receivable would be up to 85%. So if they've got a $1,000 invoice, then what's available to them is $850 or 85% of that, and then they could borrow all of it, some of it, none of it, depending on what their working capital need is. Same thing on the inventory. We'll generally lend up to 50% of their inventory asset. And on a combined basis, that gives them working capital that they need. As a non-bank asset-based lender, we don't have a lot of financial covenants, but we do want them to maintain a debt service coverage ratio or a fixed charge coverage ratio of at least 1-to-1. Meaning, for every dollar of cash flow that they've got sufficient coverage to service any debts that they incur.
Okay, that's good. What are some of the things that you see businesses not doing or taking missteps? What are some of the challenges, I guess, or even the mistakes that businesses make when they start the funding process?
I think not really understanding your actual cash needs is the biggest mistake. In a lot of cases, they choose to grow. They say yes to business, because they're anxious to get, growing and generating cash flows. But in a lot of cases, they either fail to recognize what sort of working capital requirement they need to have along the way to kind of fund their day-to-day needs. So they're kind of undercapitalized to begin with. Sometimes they get into large customer concentrations where it absorbs a lot of cash. And if, God forbid, they run into a dispute or something like that with that customer, then that customer, may decide to, delay their payment of an invoice, and they're relying heavily on having that cash to operate their business. So those are
So,
common.
yeah. So they get overly concentrated in one or two customers. One customer might be worth 50% of their revenues, and if something goes wrong with that customer, that's a big deal.
That's a big deal. So, I think it's incumbent upon every borrower to really understand what their cash flow break even is. What sort of revenue levels do they need to be performing at to cover, their week to week, month to month working capital needs. And if they're generating enough revenue and generating enough income from that revenue to service all debts, we're looking at usually, they have to be on a one-to-one basis, whereas a traditional bank is going to want you to be at 1.2 or higher, to properly perform under their facility.
You mentioned a couple of times that business owners need to know how much cash they really need. Is that something that you find that business owners miss a lot in the line? They either ask for too much or they ask for too little money that's really going to do the job.
I think they usually ask for too little. And, you think about the plight of the entrepreneur. A lot of these individuals may at one time have worked for a larger company, but they decided, what, I can go do this, for myself. So just by definition, they're usually, a strong salesperson, a strong engineer, and they say, hey, I've got great customer relationships. I can get out and do this on my own. But I think what they fail to recognize is the financial component that is needed to go ahead and properly, get out of the gate and to operate a company. So, you mentioned, mistakes that I see out there. A lot of these entrepreneurs will get out of the gate and start growing, and it's not until later that they realize, how all the intricacies of operating a business are. And so I think one mistake I see is that, when a business owner gets out there, they really ought to form their own little advisory board. If they're an engineer, then certainly they got that piece of it covered. But I think making sure that you've got a good financial advisor, a good CPA, a good banker, a good attorney, and that essentially becomes your advisory board to kind of make sure that you're addressing all of those issues, in the business that you're looking to operate.
When you're working with a business, do you consult with them if they're coming up short on revenue and some of the other key ratios? Do you work with them on how to tighten up their expenditures, their overhead? Let's see if we can reduce some areas of your expenditures, your overhead, so that we can improve the cash flow, improve the ratios. Is that some of the work? Because I imagine that your process can take several months, maybe even a year or longer.
No, generally when somebody comes to us looking for working capital, if we get a complete package, meaning the financial statements, the receivable and payable agings and inventory summaries, we can usually issue a term sheet within a week of getting that. And then if that term sheet is acceptable, then depending on the size of the credit, we can generally close on that facility, within 4 to 6 weeks. So we can move very quickly, but once they've accepted a term sheet, then we go through a pretty exhaustive underwriting process to make sure that we understand the collateral we're being asked to lend on. We want to make sure that we understand their financial statements, and to make sure that, they can perform, going forward. If they're in a loss situation where historically they're losing money, we do want to understand before we close, what do they need to do to kind of get to that break even point, and what are they doing to either reduce expenses or increase revenue. A lot of companies will come to us and say, hey, we've been bumping along, we've been doing really well, but now we just landed this huge contract. And, that's why we're coming to you, so that we can now say yes to that business we'd otherwise not be able to do. And this is what the financial statements look like going forward. So we do try to have them provide some sort of forecast, some sort of budget, so that we can understand, what do their financials look like when they layer in all this additional new business.
Right. So if a business is coming up short and you can't work with them right now, but you see some potential here, and if they tighten up the ship a little bit, you can turn a no-go into a go forward funding. Is that kind of some of the work that you're able to do, is give them some insight as to where they need to improve on their financials, and perhaps even how they might be able to improve?
Yeah, I mean, we're the lender, so we need to, just kind of underwrite the collateral and underwrite the business and their ability to perform. If we are not convinced that, they have a good, solid plan in place, if you will, to really right the ship, and return to consistent profitability, then, we'll often just say, hey, it's premature for us for these reasons. And there are, if they don't really have a financial advisor or somebody like that to really help them, prepare the financial model, so they can come up with a real plan to execute on their performance going forward, then yes, we'll recommend, folks like Crossroads, and say, look, you really need to have somebody, visit with you and kind of go through the financial modeling, 13-week cash flows, things like that, so that you really understand your cash flows, and be in a solid foundation to go ahead and service the contract that you've just been awarded.
Yeah, that's interesting. So what we're talking about here is, number one, knowing how much money you need, and then proving beyond a reasonable doubt that you can service that debt on the money that you need. So those are the two main things. And then obviously, it really doesn't matter the size of the company, because the larger companies are going to be running into the same problems as well, right? I mean, you've worked with small borrowers, and you've worked with very large. Is there much of a difference between the small borrower and the large borrower? It's still ratios and KPIs, right?
Yeah, for the most part it is. I think the large borrowers, they may have the benefit of having, better financial infrastructure. Like they'll have an actual CFO, who may be a CPA by trade, for example. And, so that person, just by definition, their mandate is to make sure they understand the financial needs of that company, and then put the information together in a format that's presentable to a bank or another finance company, so that we can then understand, why they're asking for the money and whether we can actually provide a solution or not. The smaller businesses, for lack of a better word, are somewhat at a disadvantage, because they don't readily have the financial wherewithal to afford that. So instead of a true CFO, they might have, maybe at best a controller. And that person is more of a taskmaster, to go ahead and get bills paid and things like that. But generally, they need some sort of outside accounting function to really help prepare financials in a format that would be understandable to a finance company.
Yeah, that's interesting. We were talking to John McDonald, a
Mhm.
prominent investment banker in Tampa, and he was talking about companies uh, have the end in sight. Get things lined up in the beginning, because trying to catch up, trying to modify or recreate your financials because you didn't do things right in the last 3 or 4 or 5 years, sometimes it's impossible to go back and provide adjusted financials to the level where lenders are satisfied. Do you see that a lot? Is in the structure of the financials? They're just lacking. They're not giving you enough meat on the bone
Right.
to
Right.
to uh, to approve a loan.
Yeah, we absolutely see that all the time. What is that Stephen Covey that says begin with the end in mind?
Yeah,
It really applies when an entrepreneur is looking to start their own business. They're making a huge sacrifice to get out of the gate and start something. And, they're putting their own, personal net worth at risk. And so they're eager to sell something, generate revenues, all that kind of stuff. But the reality of it is they need to take the time to go ahead and set up a foundation so that you can then grow from there. And I think with companies that we work with, a lot of these smaller entrepreneurial companies, if they are looking to ultimately sell to private equity or some sort of strategic acquirer in their space, then they need to make sure that they've got their financials, put together. They need to ultimately evolve to reviewed or better, audited financials, because ultimately, when they do go to market to sell their business, that's what a buyer wants to know. They're going to have to go through, um, all kinds of, financial due diligence to really understand what they're looking at, and they'll go through quality of earnings analysis. So if you've already got reviewed or better financial statements, you make their job a lot easier, so that they know exactly what they're buying and what they're willing to pay for it.
yeah. What are the limits on your loan capabilities, and how do you exceed? Like, if you have a limit of $10 million, I don't know if that is your limit or not, but whatever your limit is, do you have the ability to bring other lenders in on larger deals? Do you partner, syndicate deals, so to speak?
Yeah, so at Aegis, we focus on companies needing 500,000 to 5 million. And we do have the ability to fund it in that range. But typically, when a company begins to approach 3.5 million in terms of their working capital requirement, just to make sure that the company has enough runway to go ahead and continue to grow, we will, bring in other finance companies that have a very similar mindset and profile as we do from a credit risk standpoint. And we do have a couple in our portfolio that are in that $7 to $8 million range, where Aegis would essentially be, the agent or the lender of record, but we'll have a participant in there participating on the financing so that we can ultimately, fund that company's needs.
Yeah, exactly. So if your cap is 5 million, but you need $25 million, that's when you look at putting together a group or a syndicate to get to that level.
Yeah, usually when, because not only from our standpoint, most of our deals only have one other lender. We're either the one lender or there may be a couple. With the more lenders you get in there, the more opinions you have, and it gets a little bit clunkier from a lending standpoint. So usually a borrower, when they begin to need more than 10 million, they're probably better off kind of graduating from our type of financing and, looking for a lender that can either write the check for the whole thing and fund it, or somebody that, truly is a syndication shop that they can bring in multiple lenders.
So that's interesting. What sources would a business owner tap into when they're looking at, 20, 25 million or more, 50 million in revenues? What are some of the sources that you would look at?
I mean, generally when they're on that kind of growth trajectory, then, they could either go directly to a bank that potentially could, provide them the financing and run the syndication. But so that an entrepreneur really understands what their options are, more often than not, we're seeing these lower middle market companies engage the services of an investment banker. You mentioned, John McDonald, somebody like that would go in there and they can perform a capital raise, whether that be, raising more debt in the form of working capital lines of credit, term financing, things like that, or perhaps getting some equity and or sub debt in there. So usually when a company starts growing like that, they're well served in engaging an investment banker to kind of run a process, put a package together that they can then bring to market to various capital sources, and then start reviewing term sheets and helping the borrower really analyze what's the best fit to support their needs going forward.
Yeah, very interesting. How is the business environment today? Is it a tight market? I know there's a lot of money out there. Is it tight? Is it loosening up? Interest rates playing a role in this? What is the lending environment right now?
I mean, I think right now, the sentiment, I've recently gone to a couple of conferences. I think in one sense, because the election is now behind us, people seem generally optimistic that at least the narrative that deregulation is occurring, that should bode well for business, the environment in general. But I think the other fly in the ointment is what impact are all the various tariffs happening, going to have on these businesses. And interest rates remain high, at least historically. So, companies need to make sure that, they can pass on whatever tariffs, may be implemented, that those can be properly passed on to their customers. So I think the environment right now is a little bit unpredictable because those changes are just evolving as we speak. And I think until that dust really settles, I think borrowers are not going to be looking too far down the road.
So it's a little tight right now then?
A little tight. Yep.
Yeah. What kind of interest rates are we looking at, and what are usually the terms, length of the loan?
We typically, we borrow our money from banks and then relend it out. So just by definition, we would be more expensive than traditional bank financing. But again, our borrowers, because of a leveraged balance sheet or erratic earnings history or concentrations, for those types of reasons, they really can't get all that they need through a traditional bank. So we borrow from banks and then lend it out. We typically float above prime. Prime's at 7.5 today. So we're typically in that prime plus 2 to 3 range. And then on top of that, it's customary in the asset-based lending world to have, monthly fees that would ultimately, bring your total cost of financing up into the, as low as 11% all in to as high as 15% all in.
Okay. I mean, on the surface, that sounds pretty expensive, but it's what you can do with that money. If I can get this money and I can get a return on investment of 25, 30%, the borrowing costs are non-event, basically.
Correct. Yeah. I mean, generally, especially a situation where a company comes to us and says, hey, we just got awarded this big contract. We don't really have the working capital to support it. They come to us and yes, they're paying more for their money. It is cheaper than raising equity. It's not forever money. But, to your point, if an increased line of credit enables them to say yes to business they'd otherwise not be able to do, then they can justify the cost incrementally towards that increase in sales.
Yeah, exactly. Jeff, this has been great. Gosh, the information is invaluable, but there's a lot of different forms of lending because you focus on specifics within the world of lending. Have we touched on all of the different types of loans that you provide? I know asset-based lending. Is there any other thoughts that you want to impart that could generate some value to a business owner that might be viewing this interview?
Sure. So we talked about Aegis Business Credit. We focus on asset-based revolving lines of credit on receivables, inventory, and sometimes equipment in that 500 to 5 million range. In addition to that, we have Aegis Real Estate Capital, where we will provide financing against owner-occupied real estate. It could be a manufacturer that owns and operates out of their building. And in some of those cases, they may already have a working capital line of credit, either with a bank or another asset-based lender, but they need additional liquidity to finance their business, and they've got equity in that owner-occupied real estate. So we'll provide additional liquidity by lending against owner-occupied real estate. Same thing there. Generally, those deals are in the 500 to 5 million. I would say on average, most of our deals are in that 2 to 3 million range. And from a loan to value standpoint, we can go up to 70%, but most of our deals are in that 60% or less loan to value. And then the third vehicle we have is called Aegis Venture Fund, and that's where a company may have an asset other than real estate, inventory, receivables. They may have intellectual property. They may have some personal assets they want to leverage to go ahead and put into their company. We can underwrite deals in that as well. Those are typically very small facilities under $1 million.
Yeah, that's interesting. I'm sure we could talk much more about the whole world of funding. Obviously, our viewers can reach out, get your contact information through us. We're happy to facilitate introductions. But if they wanted to reach out directly to you, if they have questions or actually want to pursue lending, what would be the easiest way for them to contact you?
They could email me at jmitchell, MITCHELL, at Aegis, AEGIS, businesscredit.com. That's probably the best way, but my phone number as well is 813-205-1538. And would love to hear from anybody that would like to explore this further.
Very good. Jeff, thanks so much for your time today. It's always fascinating to talk to you about the world of funding. So important to businesses today. Well, probably as is always, right? It's all about money and getting access to money, and those who can get access to money, they win a lot of deals. Keep in mind that Crossroads Consulting, we're here to help you with your outsourcing needs, help you find ways of growing your company and certainly protecting your business assets. We have a link below this video, and if you want to add any questions to the comment section, we will get the answers from Jeff, and we'll connect the dots. Thanks everyone for joining another XR Insights, and we look forward to future interviews and more great information in running your business. Thank you all, and have a great day.
All right. Thank you, Jeff.
Thank you, Jeff.
Bye-bye.
Once again, we are Crossroads Consulting. I'm Jeff. He's Billy. We're available to talk to you about any issues that come up with regards to your business. Our business model is to help you find solutions. There's no cost, there's no obligation to talk to us. You've seen some of the interviews that we've done. We have a lot of resources that we can bring to the table. We welcome you the opportunity to talk to you about your business and some of the challenges that you're facing now. We'll do our best to find the solutions. Again, there's no cost, no obligation.